What's up, everyone? Here's an example of a trade we took the other day and a breakdown. So as always, we always like to mark out our liquidity points. So we took this trade in New York session. That's the primary time frame that we trade. So we want to mark out the highs and lows of the previous session. So we have this high of London session, which was at about 3 to 3:05 a.m. And we also have this high from Asian session that we've already marked out on our chart. As the 9:30 open came into play, it pushed the price higher and it approached our liquidity point. So at this point, we're waiting to see if the point is breached and how it responds. You can also confirm that this could be a fake move essentially from the TDI. So you have hidden divergence. Basically, you see this high on the chart is lower than this high, but on the TDI, this high is basically at the same point of this high, which doesn't make sense. So that's a hint to a discrepancy. So at this point, we're waiting to see if price breaches the zone and how it responds to this. And we're also going to look at our indicator as well. So we already have the zone marked out right here, or the 3 a.m. liquidity point marked out right here, and price is in our zone on the 1 minute time frame. And as it moves to the liquidity point and breaches it, our indicator actually fires right here. So we can actually enter right here, or if we want to wait for the engulfing candle, we can wait for that as well. So either way, we have price moving into the zone marked out on our indicator, as well as the signal firing. So we entered the trade and we had an easy 1-to-1, if not a 1-to-2 risk reward ratio that was achieved. And for some that held, we're able to get a 1-to-3 or even maybe squeeze out a 1-to-4. So that's a quick breakdown of this trade recap on S&P 500.